Welcome all to the Node. I am Mike, aka Veteran Crypto. And on today's show, we are going to be covering a little bit about Polymarket and an upgrade that they are doing. We got some Canton news, of course. Daily, there's news to cover as far as that's concerned. And we are going to be doing deep dives on both Maple and Alpin. So those that don't know, let me pop on over here. Maple is a DEX that it focuses mostly on borrowing, like borrowing and lending. So actually, hold on real quick. All right, hold on. Let's add David here. Getting some.
All
some
righty.
errors. Do you want to take over real quick? I'm getting some errors on the X streams.
Sure. So Maple. Now, what I know about Maple Finance is that it's an RWA protocol, like an institutional RWA protocol. They have like a bunch of, probably treasuries, and I think it's private credit type stuff on Maple too. I don't know if they are, the company responsible for syrup or not.
They are.
I don't. They are. Okay.
Yeah.
So
we'll
I think
doing a deep dive on that here in a bit.
Awesome. Okay. So Maple RWA and that syrup protocol, that syrup token. So to be completely honest, I don't really know a whole lot about Maple. I remember, I had clients who were providing liquidity in, I think Maple has a token. I think it's MPL, if I'm not mistaken.
And we're going to find out. The only one that I know of is Syrup.
Yeah, so Syrup, I think, is one of their, RWA products, but MPL USD, I think that's the token. I'm looking at it right now on my screen on TradingView. And I do remember in 2024, clients were providing liquidity in MPL paired with ETH and paired with a stable on Uniswap. And when there was a ton of trading volume in that, in basically like the beginning of 2024, the spring of 2024, people did really, really well providing liquidity in that thing, but just for a very short period of time. Those volumes don't last for very long. So Maple, what else do you see here?
Alpin is the other one we're going to be doing a deep dive on. I'll be honest, the notes that I took, I know we talked on Friday that we were going to do some deep dives on some things, and I lost my notes. So I had to pick some other stuff. Do you remember what it was that we were going to cover today?
The stuff and the things at the place,
the things,
with the guy.
Yeah, don't worry. He has the things. So we'll talk after the show. But I totally freaking lost the notes. But one of the big things I want to cover today is Polymarket. So it looks like they are doing a big upgrade, and they are. Let's see.
Aren't they doing? They're launching perps, right?
Yeah. And so I wanted to get your input on this because this is like right up your alley, and I believe it's something that you even mentioned that if they launch something like this, it was going to be a game changer.
Well, they've got to be able to make it available to U.S. citizens natively. That's got to happen. And I don't see how that is going to happen until that Clarity Act passes. So I don't know where they're launching these products. Are they launching these products just to Europeans? I know they've got a MiCA license, right?
I have not seen where they have a MiCA license. Let's go through some of this.
I think they do. They might. I'm not sure if they do or actually.
All right. So it looks like Polymarket B2 upgrade that officially rolled out end of April, is a massive overhaul to the platform's core infrastructure. It shifts the platform from a standard crypto betting application to a highly optimized quasi-exchange infrastructure designed to handle institutional grade volume. The major details of the upgrade across the core components are broken down. The collateral overhaul. So they're moving to PUSD. I would be. Let's see which one that is because we know that there's. Okay, the Polymarket USD.
Yeah.
All right. So it completely dropped USDCE, uh, the legacy bridged version of USDC on Polygon, as its settlement asset. So the platform introduced Polymarket USD, PUSD, an ERC20 token on Polygon, backed one-to-one by native Circle issued USDC. This completely eliminates the smart contract and latency risks associated with bridged assets that we have seen issues with. It tightens the plumbing, lowers the bridge friction, and guarantees a more direct path for liquidity. So less bridging, so there's, less issues as far as sandwich attacks and things like that. So, uh, what are your thoughts
So,
on
Mike, yeah. So here I've got Polymarket pulled up actually right now. I've got a market on Polymarket pulled up. This is just one of the crypto markets. So this is, let me go ahead and share the correct tab there. So this is just one of the crypto Polymarket markets on Polymarket, a Polymarket market on Polymarket.
Yeah.
And the cool thing about these markets is that these are binary options. That's what these things are. And so if you're taking a look and you see, okay, well, if I buy the yes shares, and what I'm saying is, okay, I think that Bitcoin by this date. So when you see by this date, and remember, keep in mind, these are binary options. So if you see by this date, that's your expiration date. So your expiration cycle would be, however many days there are between now and July 14th. In this case, it's 1 day to expiration. So you got to think about these as if they're options, because they are. So you would be trading essentially a 1 DTE option. That would be your contract date to expiry. Okay. And then if you're taking a look and you're saying to yourself, all right, well, by tomorrow, July 14th, whenever this market resolves, and you've got to scroll down here to find out exactly when the market resolves. Those are super important. When you look at the rules here for each one of these markets on Polymarket, you've got to read the rules. Super important. So this market is going to resolve at 12 Eastern time. So 12 Eastern, that's noon tomorrow. So now you know your expiration date. That's number one. Now, if we scroll up here and we take a look at these specific, you would refer to these as strikes. Now, in this case, if I'm talking about like a range, a strike range between 58 and 60K, that's almost as if you're trading like a fly. So maybe a put fly or a call fly. And so when you're trading flies like that, what you're saying is you think price by expiration will be within a specific range. And so what Polymarket allows you to do here is trade basically like really complex option strategies simply by buying a yes or a no share. And the beauty of this is that on Polymarket, you're trading against other individuals. You're not trading against the house. On Kalshi, you're trading against the house. On Polymarket, you're trading against other traders. And so what that means is sometimes these markets can be blatantly mispriced. So what does that mean, right? Well, if the market's mispriced, here's an example. If I'm going to trade this, if I'm going to say, okay, by tomorrow at 12 noon, I think that Bitcoin's going to be between 58 and 60K. If these yes shares trade at a premium to these yes shares, that would be a massive mispricing. And so what you could do is you could sell these yes shares by buying the no shares. So if these yes shares for the 58 to 60K range, for that strike range, if these yes shares were trading for greater than 31 cents, these yes shares for the farther, so this is farther out of the money than these are. So Bitcoin's trading right now for what? 62.5. So if Bitcoin's trading for 62.5, then this is at the money. So you see here where it's got 57% chance of resolving in this range. This strike range would be referred to as at the money, and therefore it's got the a closer to 50% chance of expiring in the money. Yeah. So what you could do here is if you follow these markets closely and you see a massive mispricing, and what that would look like would be something like, okay, you can't have a further out of the money strike be priced at a greater premium than a closer to at the money strike. That is a blatant mispricing. And so because you're trading against individuals here, if you see a mispricing like that, you could instantly step in and arbitrage away the difference and lock in a profit on entry. So that's the beauty of some of these markets over here on Polymarket, is that if you are an options trader and you know how to read this such that it looks more like an options chain in your mind, then you can spot amazing opportunities here on Polymarket sometimes. But a lot of that stuff has been getting arbitraged away as more liquidity has flowed into Polymarket markets. But I know that they're about to launch perps on here.
Yeah.
And that'll be pretty interesting. I wasn't really able to find a whole lot about it on X as I was just searching a moment ago. But
one thing I can answer is I looked it up, and it looks like it's severely limited for anybody that's governed under U.S. regulation or under MICA. U.S. access is allowed, but not the international site. So the U.S. regulated exchange, it looks like you can access that, but it's full KYC. And then European users governed by MICA and the ESMA is heavily restricted or blocked.
Yeah, that sucks.
Yeah.
So, yeah. And I mean, I think that we're going to see more and more of that, these KYC AML restrictions where governments want to be able to track your money, where it is, how much you have, what are you doing with it. So, hey, where's my cut?
Yeah.
They're looking like, where's my cut?
That's really what it boils down to is, they say it's for our safety and stuff like that. But what it really boils down to is control, and they want their cut.
For the children. It's
the little babies. It's we're trying to protect the little babies with the trading, because we don't want the little babies getting hurt in the trading.
Yeah, you got to protect, against that money laundering, don't you know? When all they're trying to do is make sure that they can take from you. But so Polymarket and Hyperliquid both have prediction market products now, and I'm just comparing the two on the screen, Polymarket and Hyperliquid. I believe the Hyperliquid prediction markets are much cheaper to trade than they are on Polymarket. So I brought this up here, and I'm not really seeing that they are. Maybe I'm looking at the wrong data here. But you can see the maker-taker spreads.
Yeah.
So let's see here. What else we got?
They're trying to give Hyperliquid a run for their money.
I think Hyperliquid's trying to give Polymarket a run for its money.
Polymarket's the one that's that's launching the new, and it looks like their taker maker looks to be like they're just barely undercutting Hyperliquid.
Yeah. So, but if you take a look on Hyperliquid on the exchange, and you hop into the outcome markets here, and maybe we take a look at economics, right? So very, very low volume. I don't know that you could really even trade this stuff. Although with that low volume, if you really are willing to make a commitment and say, hey, you know what, I'm going to put my money where my mouth is. I think that I can make a commitment here, and I can, maybe I'm right. You think you're right?
Yeah.
You might be able to do well in a market where it's very illiquid, but super dangerous. Probably not a good idea. Yeah, but at least, for the economics here, you got July Fed funds decision. And then you got the June CPI year-on-year change. So if we head on over to FedWatch just real quick, we got that next FOMC meeting in 16 days. And what I was talking about last week, Mike, was watching this. So you see the 375 to 400 right here. This is, right now, a 39% likelihood that in 16 days, the FOMC, the Fed, raises rates. Not a hawkish hold, not a dovish cut, but a hike, an actual hike of 25 basis points. And so there's a 39% probability assigned to that outcome right now. So that's going to be pretty interesting. Now, what's going to drive that? I think it's going to be CPI, whatever that CPI print is. And don't we get CPI tomorrow? Doesn't it come out Tuesday mornings?
I believe so.
I think so. So what is the expectation for CPI? Because, as we've seen this war in Iran, start to ramp back up again, it looks as though crude, now that it's breaking back out above its 200-day moving average, it looks like crude might actually, if it's able to get back up above that recent high. So that high was put in Wednesday, July 8th. So the high of the day on Wednesday, July 8th was $76.08. If crude breaks out above the high from a couple of days ago, that would be a little bit of a trend change, a swing back to the upside. So if we get that swing back to the upside out of crude, that would likely mean that rates continue to push higher. And if we take a look at rates on the 10-year, rates are pushing higher today, this Monday.
What's crazy about fucking oil prices is it's gotten significantly cheaper. Like oil production has gotten significantly cheaper, yet the price seems to just hover in that range.
Yeah. I did see something about crack spreads, that crack spreads had blown out, but I don't know enough about crack spreads to be able to really opine. You know what I mean? So, opine.
Opine about spreading cracks. All right.
Yeah. But yeah, man, I'm looking at yields here. Rates pushing higher and breaking out above that level that was put in at the beginning of June. So if rates continue to push higher, and they've broken out again, so this level of downtrend, this level of down sloping resistance. So now that rates have broken out above that high from the beginning of June, the target is up here at those highs from the middle of May. So those highs in May were at 4.685%. So we've got to watch CPI tomorrow. If CPI comes in really hot, yields are going to break out. They're going to go higher. So if we take a look down my watch list here, I got a bunch of Western developed democracies, their bond yields here. So the Japanese 30-year, this one's super important to watch. You got that, what's left of that Japanese carry trade. If this continues to break out, we would see the yen weaken, I think, substantially. And then if you take a look at the US 30-year, sitting above 5%, 5.093% today. And there was that breakout that we saw in the middle of May. But, look at where it found support of the 200-day moving average. So if it breaks back out above this, downsloping, this, very shallow level of downsloping resistance, if it breaks out above 5.125%, 5.125% on the 30-year, I think it goes back up and retests 5.20%. So why is this important, right? Well, why is tracking yields like this important? Well, because we're digital asset investors here. And so whenever yields push higher, that tends to not be a tailwind for Bitcoin and other digital assets too.
Yeah, or any risk on assets, really.
Exactly. Yeah. So, if we see, the S&P actually start to correct here a little bit, as rates potentially push higher on the back of a hot CPI print potentially, then what I think you would see is the likelihood that we get a hike at the next meeting. I think that would get priced out. So we'll see how the new FOMC chair, Kevin Warsh, we'll see how he sounds in 16 days. It's going to be really important to listen to his presser and listen to the way that he sounds, because I think that market participants are starting to feel him out a little bit. See, is he really a hawk? Is he a dove? Is he a centrist? Who is he? So we're going to find out over the next couple of weeks.
Absolutely. Well, this is a little bit of Canton news. So it looks like Edel Finance prepares Canton native perpetuals venue for tokenized assets. So Edel Markets is expected to launch later this quarter as a Canton native perpetuals venue for tokenized equities, commodities, and future multi-asset markets. Its design combines private positions, order book execution, API access, and on-chain settlement. Edel Finance is preparing to launch Edel Markets, a Canton native perpetuals venue, and for tokenized equities, yada, yada. Announced July 9th, the product follows the rollout of Runway, Edel's participation platform on Canton Network. Edel Markets is expected to launch later this quarter with a waitlist currently open. The venue is being built around 4 components: private position state, central limit order book execution, native Canton settlement, and API first infrastructure. It will enter through a trading interface or API before passing through the order book, matching engine, and risk and margin checks. Settlement will take place on Canton, bullish, while position information will remain visible only to entitled participants. Privacy layer. That privacy model is central to Edel's decision to build on Canton. Exactly. Equity and commodity markets operate within disclosure rules, compliance requirements, and information barriers that can make publicly visible positions unsuitable for professional participants. Canton is designed to allow transactions to be verified without exposing all associated information across the network. This is what we're talking about when it comes to a big reason why a lot of these institutions are rolling with Canton is its native privacy layer, where it connects all of these siloed networks, gives them the interoperability, gives them the speed, gives them the security, gives them all the things that blockchain technology gives, but it doesn't have the issues of the public chains. It doesn't have the issues of the legacy systems. It's kind of all the benefits with none of the negatives. So, I mean, what does this mean to you, David? As a trader.
So, what I'm thinking about here, if I were a CC token holder, I would be thinking about that value accrual model. Like that's the thing. So, I saw, Mike, in my X feed earlier this morning that those subnets are going to be going live pretty soon.
Yep.
And when they do go live, it looks like they're going to be burning CC.
Yep.
So we always talk about the trifecta, right?
Yep.
User adoption and user growth, revenue generation, and value accrual. Those are the three items that you've got to be tracking if you're a token holder holding any digital asset token. Doesn't matter what it is. And CC, yeah.
Oh, go ahead.
Yeah, so CC has a pretty great value accrual model. They generate a ton of revenue and obviously a lot of user growth. Doesn't it look like that? It looks like every institution is clamoring to be able to jump on those digital asset rails, those CC digital asset rails.
Well, to become validators, super validators, and this is actual real adoption. This isn't the hype that you see on most projects. Most projects you see that they signed an MOU or they're in talks with, or they're part of the same advisory committee. An advisory committee is not adoption. That just means that you're on a panel of other institutions that are advising how to build something out, or how to potentially bring traditional assets on chain. That's all that is. I mean, you really need to pay attention to the details, and I have some examples of what I'm talking about here in a minute, because there's some projects that are terrible at it. They try to hype it up to where this is gonna pump the token, and it's like it has nothing to do with the token. It has nothing to do with anything bullish for the project. It's
so Mike, my favorite, and I'm being completely sarcastic here, but my favorite projects are the ones where they use like Gmail or like Google for hosting or something. Yeah. And so they'll put like in a banner somewhere like, oh, we're partnered with Google.
Yeah.
It's like, oh, really? Tell me about that partnership with Google. It's like, well, actually, we use Gmail. Like, that's not a partnership. Like, so you always got to dig into the details.
Yes.
We see so many projects out there that say partnered with insert name of institution here.
Yeah.
And then they say, oh, sometime in the future, this could maybe, hopefully, kind of do something good for token holders. And it's like, man, that's a bunch of bullshit.
There's so, and a lot of people, feel like that it's fun to talk like this. It's like, no, it's realistic. It's factual, because there's a lot of hurdles that you have to look at. You have to look at, okay, going from an MOU or just being on a council, to actual adoption, to where they're using the technology, the products, the services, the network. And then, is it generating fees and revenue? Then, what part does the token play in that? Does the token have any value capture? Because long term, it's like, yes, like we always say, you can trade, that short term volatility, that, the speculation, the hype, the mind share. all of that has value. You can
And
trade that.
totally valid
Yeah,
to trade that, not taking anything away from traders who make money doing that.
yeah. But you need to understand the difference between, speculative, price moves and long-term value accrual. And that is what we focus on here. So, this is something else, about this, Edel. So Edel stated, their objective is to build infrastructure on which institutional participants, retail users, and technology providers can operate across tokenized lending, trading, and derivatives without making every position public. So they are looking to onboard a lot of these organizations in a lot of ways, like Zenith. We had the interview with Gustav, the head of ecosystem over at Zenith, and that's kind of what they're doing. Is they're bringing EVM compatible dApps, Ethereum applications onto Canton Network. That is potentially going to burn more fees, but that is going to onboard more and more adoption. So what it all boils down to, and this is part of the trifecta, is adoption. The more adoption you get, if the tokenomics are right, then you get more fees and revenue that is generated through the transactions and data. That's something I learned from Scott. What was it? What was his handle on X?
Shitfire.
No, no, no. He was on the show on Friday.
Hold
on, I'll find it.
Yeah, we were talking about how amazing Longview Compute. Yeah, we were talking about that amazing XRP project.
Well, Longview Compute pointed out something, and so it as far as fees on Canton, it's not necessarily the amount of transactions; it's the amount of data that is in the transaction that constitutes the amount of fees that are generated. I did not know that.
I didn't know that either. Yeah. Does that have something to do with DAML? DAML? Like
I think that's their know. But Longview Compute is he's the only person I've found so far that is more knowledgeable about Canton than us.
Yeah, well, it was great to have that conversation with him. That was really a lot of fun.
Yeah,
we've got to have more conversations like that, because the thing that was so great about and his name was Scott, right? At Longview Compute.
That's
the great thing about speaking with Scott on Friday evening was we were able to go back and forth about facts. Okay, there is such a thing as objective truth, and so we started by talking about Ripple Labs and XRP, and hey, look, I'm going to give credit where credit is due. Ripple Labs is a private company. It looks like, because they're private, we're not going to get any, there's no disclosures there. It looks like, though, they generate, 9 figures a year in revenue, top line revenue, something like that. If we had
what was it? Only 5 billion of it was, on the XRPL, and there's no fees being generated.
Well, yeah. So it was like 80 or 100 billion is basically off chain, and then 5 billion is on chain. So, if we're just talking about like real objective facts, holding XRP doesn't really make any sense. There's no value accrual. But the great thing about talking to Scott was, it was a respectful conversation about facts for these projects.
Yeah.
And when you start going through the facts, some projects start looking like doo-doo, or at least holding the token does.
Yeah.
And I think XRP is the very top tier doo-doo. So.
Well, it's because it has such a massive market cap, and for the most part, it is purely from hype and misinformation. In fact, I'll bring some up really quick. This is the kind of stuff that we warn people against. Where is it at?
And so some of the numbers that we were throwing out there on Friday, so Ripple Labs has done $100 billion in remittances, but it's all off chain. It's all that ODL. And they have generated, it looks like, revenue from that. But the vast majority of the revenue that Ripple Labs generates is from dumping tokens on retail. So from the information that we saw on Friday, it was like between 1.5 billion and $3 billion in 2025 from sales of XRP tokens. So you just got to ask yourself, what value is there in holding that token as a retail investor in digital assets? I would submit to you and everyone watching exactly goose egg. Zero, zilch, nada. Yeah.
Well, I didn't tag it, but I was reading it this morning. Somebody posted something, claiming that Ripple was listed as that Swift was going to be using them. And this is a super old narrative, but they had some, looked like it was a Photoshop document that was showing that it was on like basically another advisory board or something like that. And it's well known. It's well known that Swift, they built their own blockchain and they utilized Linea and Chainlink. They utilized Chainlink for interoperability and they utilized Linea for the messaging aspect. And they're not using XRP. They're not using the XRPL. They're just not. Now will Ripple use, potentially use Swift if they become a bank? Possibly. Is there going to be interoperability with the XRPL? Probably. But are banks going to use the XRPL? Or are they just going to use Swift's infrastructure that they're currently integrated with that works just fine? Banks are slow moving. They don't like change. They like the status quo. They want the power. They want the control. They don't want to be paying a third party, like Ripple, and especially if they're a competitor. If they're a bank as well, they don't want to be funding, funding and growing their competitor. So
that's actually, why they came out with OUSD, Mike, for sure. Yeah.
So they don't like competition. They don't want to feed their competition.
And right now, Tether and Circle, those are two big competitors to this TradFi, all these TradFi rails. So when you see a product like OUSD with 140 institutions signing on to launch this product, what are they doing with that? Well, they look at Tether and Circle and they say, hey, if we facilitate transfers on our digital rails using USDT and USDC, we earn none of that float. Those yields from holding treasuries, we get none of that.
With OUSD, they get that treasury yield, and they get to keep that. So that's like an extra 5% ish,
something like that. It's whatever the 10-year is. So like 4.6%. So why would they give that 4.6% to Tether and Circle when they could capture that themselves? I think they like money.
Yeah, no, they do. Money. Yeah, it's all about the money. And then this guy has B Fritz. He has a valid point. On this one, the company that owns 9% of Ripple doesn't want to use XRP. Why are they using Sol and Link instead? So just in 230 billion SBI Holdings teams up with Solana to create Japan's first crypto financial market. SBI says it will use Solana's high-speed, low-cost network to support the JPY stablecoins, tokenized RWAs, and cross-border payments and institutional financial services. So this is one of Ripple's, freaking partners. They own, according to this, I need to fact check it, but according to this, they own, this guy, 9% of Ripple.
Yeah, I mean, if I owned 9% of Ripple, I would be pushing that guy Garlinghouse. Like, launch some products, bro. Like, where's your product suite? You're trying to compete with Swift. Okay,
Ripple Payments is like really the only thing that they have, and nobody's really using it.
Well, I mean, someone's using it. $100 billion in remittances or cross-border payments or whatever. Then
when you're dealing with. Nothing. Yeah, well, when you're dealing with the global financial system,
it's very small.
Well, and I would like to see what's included in that 100 billion. And you're right, 100 billion is no small thing, but also I would like to see what exactly that is, because I mean, if that's just them moving money around, if that's I don't know, tests or I would like to see some details on that.
Me too.
to really find out how much weight it has.
Yeah, verify, don't trust.
Exactly. Well, just like No Hype says, I personally think these partnerships are all BS. I would tend to agree in most cases.
I do
Um,
too.
so let's see what else we got.
So I was taking a look here a little bit more about edel markets
Yeah,
because I'm always focused on value accrual, right? So it looks like edel markets is essentially going to be a DEX, right? It looks like it's going to be a private DEX built on top of CC rails.
yep,
So that looks pretty interesting to me. So private position state. So on traditional blockchains, right? Large trading positions, they're doxed. They're fully visible. And
yeah.
so think about it this way: if you're an institution, or maybe you're a hedge fund, you're trading a proprietary strategy, you spend all this time developing your strategy, and you've got an edge, and then you start entering trades, but everything is doxed on a public chain. You can't have that, because then your competitors can step in and
Yeah.
maybe not front run you, but they can track all of your trades, and they can rebuild your strategy and steal your edge.
Well, and that's they spend a lot of money building out these strategies that they use. And so, like you're saying, if they can see all the transactions, especially with AI, some advanced AI, they could freaking plug it in, have it 24/7. If everything was visible, basically track all the trades they're making, everything they're doing, and they can see if they're front running something, if they're shorting something, what sort of yield strategies that they're using, and basically, like you said, I mean, it takes away their advantage. I mean, it's they whatever these institutions. It's the reason why the big reason why I think Canton is getting so much traction is because of that native privacy layer. So, here's another one.
Yeah.
Grayscale names Canton among 5 networks positioned for tokenized equities. Grayscale says Canton Network is positioned to benefit as equity tokenization moves into regulated market infrastructure. Ethereum, Solana, BNB, Avalanche, interesting to see, could capture other parts of the market as 3 ownership models develop.
Now, Mike, if you could pause it right there on the other chains that have been identified for tokenized equities, in addition to CC Canton. So Ethereum, right, with all those EVM layer 2s, BNB chain, okay, that's a layer 1, but it's also, there's BNB chain, that's the EVM compatible layer 2.
Yep.
So those 2 coins, BNB and ETH, they've got solid value accrual models. Now, I know that people will disagree with me when it comes to Ethereum, but that's okay. We can have a conversation on that. Now, Solana has some tokenomics problems.
Yeah.
And, I believe that at the old all-time high, this past bull for Sol, the Sol token, the circulating supply had actually doubled from when it put in its previous old all-time high 2 bull runs ago in 2021. So that is a ton of inflation. And if you buy Sol and stake it, and you're earning that 7%, staking yield,
it's not keeping up.
It's like you're barely breaking even with the inflation rate for that coin. So that's a problem. I think that they're focused on fixing that. I saw some improvement proposals for Solana where it looks like they're going to be able to hopefully fix that problem. But there's a lot of adoption for Solana. OUSD is launching natively on Solana first, along with Ethereum and a couple of layer 2s. But AVAX, the Avalanche, they've got 3 chains: the S chain, the X chain, and the C chain.
Yep.
And Avalanche, really not good tokenomics there. No. Really not good.
One thing I am starting to see a trend, though, is a lot of, not Avalanche, I haven't seen anything on Avalanche yet, but a lot of older chains are starting to push to make changes to their tokenomics to include value capture.
They have to.
Well, and I'll be honest. I mean, I know there's a lot of channels out there, but we were one of the first to start pointing this out. And I'm starting to see a lot of other channels start to chime in on this.
We're the first. We're numero uno. We're number 1. We're first to talk about value accrual. Yeah, that trifecta that we came up with, no one else is talking about that except for us.
a couple months. It was months and months ago that we started talking about it, and I'm starting to see more and more people, latch onto it because it makes sense. I mean, why hold a token if there's no connection to the success of the company? If there's
Right.
no connection to the fees and revenue that are generated. I mean, basically, you're giving your liquidity to them to bootstrap a company, and you have, you have skin in the game, but you're not really in the game.
You got to get compensated for taking that risk.
Yeah.
And if there's no value accrual, there's no user adoption, and the protocol doesn't really generate revenues, then, what's the point of holding the coin? There is none. But yeah, what else is going on in this Canton News article?
So it says in research published July 9th, so Friday, Grayscale head of research Zach Pandel divided the market's development into three phases, each favoring different infrastructure. Canton's role is tied most directly to the second phase, regulated entitlement systems connected to existing market infrastructure. The Depository Trust and Clearing Corporation, the DTCC, plans to use Canton, supposed to be launching here in a couple of days for a soft launch, as the first blockchain in its tokenization pilot. And then supposedly there's going to be the full launch this October. Canton Network is the only one that is locked in for a launch with the DTCC in this tokenization pilot. There is talk about XLM the first half or H1 of 2027. That's the only official.
Yeah, no, I know you're right. Yeah,
That's the only official announcement so far. So all this talk, because XRP and Ripple Prime and all that is on the committee, that means nothing. That means
right.
that they have a seat at the table to discuss, how they're going to do this. It could lead to something, but the only thing official that it is going live on right now is Canton and potentially XLM. So I just want to point that out.
Well, so if we could just pause for a second and talk about XLM Stellar. We ran deep dive research
Oh,
on
the
XLM
tokenomics
Stellar.
stuff. Yeah.
Yeah, no good,
No value.
and none. And also, when you see like, okay, they're potentially going to have a soft launch. XLM Stellar is in first half 27 for tokenized equities. Well, it doesn't work right now. It just doesn't work on Stellar right now. That's why they're talking about sometime in 2027, because it can't work right now. But where it does work right now, Canton. So I think that liquidity is going to go to where liquidity is treated best. Liquidity is going to go to where there is deep liquidity already. So I think what's going to happen with these blockchain wars, Mike, is winner take most. So first to market, Canton. And as long as they continue to mop up all this liquidity, then there might be all these announcements of partnerships and yada, yada, yada. But hey, if it's already running on Canton, then that's where the liquidity is going to flow.
Dude, this is a valid point here. So listen to this. So this pilot is bringing eligible securities on chain through regulated post-trade infrastructure rather than issuing replacement assets.
Right.
This model differs from the third-party wrappers that dominate tokenized equities today. Grayscale estimates wrappers account for more than 70% of tokenized stock market capitalization. In this structure, conventional shares are placed in a special purpose vehicle while investors receive tokens representing claims, an IOU, on that vehicle rather than direct ownership of the underlying stock. David, break that down for us.
Oh, man, that's a big deal. So we're talking about on-chain origination here a little bit. So big difference between holding some tokenized wrapper for an equity that lives in, a TradFi broker somewhere. That TradFi broker has custody of that equity asset. And what they do is they mint a token in a wrapper that's like a derivative of.
So like wrapped BTC or basically something where it's an IOU.
It's not the real McCoy.
No.
It's just not. It's a derivative of. And so if you talk about WBTC, this is a great example. So if you hold spot Bitcoin and you self-custody that spot Bitcoin, you own that. That's the real thing. But if you hold WBTC on, let's say, an EVM chain
Or
or
if
on
you hold it on
Solana
Coinbase.
or on Coinbase,
Yeah.
you don't actually number. So if you hold WBTC in your self custody, your hardware wallet, you have custody of that WBTC. If you've got CBBTC on Coinbase, then you don't actually own anything. Coinbase does.
Yep.
But the big difference between the wrappers and the real McCoy is, let's say that you hold WBTC.
Actually, really quick, one thing that I learned is on Coinbase, I bought a strategy, STRC or whatever, and that's supposed to pay dividends. I bought it on there, and because it's a wrapped version, I don't get those dividends. I still need to sell that, go over to Robinhood, buy it over there, the actual stock, so that I can get those dividends. So, I mean, that's a perfect example of, so basically Coinbase is probably, getting the dividends, not me.
Yeah, that's no good. I would exit that position ASAP yesterday,
Yeah.
and
I mean, it's a couple
migrate.
$100, but I was just kind of playing with it because I was curious. I couldn't find anywhere in Coinbase's documentation where it told me if I got the dividends or not. So I wanted to do it for the channel, and this is a perfect time to announce that. That is the difference between a wrapped version and the actual owning the actual asset.
Super important to understand the difference. If we're going to talk about WBTC for a second, to understand the difference between a tokenized wrapper and the real McCoy, in the context of these tokenized equities, it's very, very similar when we talk about spot Bitcoin and WBTC. If you own spot Bitcoin and you self-custody, you actually own that asset. You have custody of that asset. If you own WBTC and you self-custody, well, you've got custody and ownership of that asset too. But the problem is it's not spot Bitcoin. It is a tokenized representation in a wrapper of Bitcoin. Now, it's supposed to be backed one for one with spot Bitcoin, but that spot Bitcoin, I believe, is custodied by BitGo. That's the custodian. So what do you know about BitGo, right? If you're holding WBTC and there's some problem with BitGo, the custodian for that spot Bitcoin that's backing your derivative, that wrapped WBTC product, then if there's a problem with the custodian, you could see your WBTC token potentially depeg. And if it depegs, then you might be stuck getting forced to exit that. Well, not necessarily forced. If you're not taking on any leverage, you could just continue to hold it. But if you're holding WBTC and it depegs from spot, then let's say Bitcoin's trading for 62K and there's some problem with BitGo and you're holding WBTC, it could depeg from spot. And so all of a sudden it could be trading at 50 cents on the dollar. And so now if you want to swap out of that WBTC, you're going to get stuck taking a 50% haircut. Now that's a theoretical example, right? I'm not saying that's going to happen. All I'm saying is you need to understand if you're holding a wrapped version of some asset, you don't actually hold the real thing. And that's why these tokenized equities on Canton, that's why they're so much different than tokenized equities just about anywhere else. Because if you're holding tokenized equities on, let's say, Solana, and you got X stocks, that's a wrapper, right? That's not the real McCoy. But if you've got tokenized equities on Canton, that is the real McCoy, it looks like. Big difference.
No, exactly. And it was actually talking about, let's see, there's one that has actually done this. Where are we at here? Securitize. So Securitize is the first public company to tokenize its own common stock at the time of its New York Stock Exchange listing. So, that's big because that is the momentum that we're seeing. We're seeing that, these, companies that are on the New York Stock Exchange, and, those that don't understand, the DTCC is owned by basically the New York Stock Exchange and a bunch of institutions and organizations. And so anything that the DTCC is doing, it's going to be in line with potentially, again, there's still a lot to be determined, but potentially the New York Stock Exchange, if everything goes well with this, soft launch, and if these other, Ethereum and Solana, potentially Avalanche, and potentially other networks that could be brought into this, because nothing says it's only going to be Canton Network. There could be a bunch of different chains that handle different aspects. We don't know yet. We're still very early, but we are just stating the facts as we know them right now. And the New York Stock Exchange and a lot of these banks and institutions, they again, the DTCC, it consists of all of those. So if they're doing this, they're all sitting around a big conference room table, and they're the ones deciding to launch first with Canton Network. So it tips their hand. Let's just put it that way. So
Mike, this article, this is really interesting to me. In fact, we need to run deep dive research on the Robinhood chain this week. We've really got to do that because I've seen some amazing numbers coming out of that Robinhood chain, and I'm starting to see a lot of people. That meme coin season that we saw pop off in the at the end of
there's a bunch of meme coins being minted on Robinhood right now.
I know. Yeah. And the volumes are massive. Mm-hmm. And, what I remember from 2023 and 2024, and to a lesser extent, 2025, but also in 2025, the meme coin seasons that we saw on Solana.
Oh, ridiculous.
What we're seeing, I know. And we're seeing something similar on Robinhood chain right now.
Mm-hmm. So how Lighter powers Robinhood perps with USDG as the quote asset. So Robinhood chain perps now run on Lighter. We did a deep dive on Lighter, and it's been doing pretty well. And if I remember right, didn't it have a pretty good value capture?
So let's see here. Let me hop into the Intel library and see if I can find Lighter. I don't think we did on Lighter.
Maybe that was the one that I was supposed to do. Let me see.
Yeah, let's do Robinhood and let's do Lighter. Let's do that for tomorrow. Those will be really interesting for everyone because they're topical right now. It's in the news. You see Robinhood just launched. They're crushing it in terms of volumes. Yeah. Lighter is doing really, really well. The token has been performing extremely well. So I think those will be really valuable pieces of deep dive research. So if we take, this is STRC. So this is the stretch product.
Hit Lighter. We only got about 7 minutes. I want to get through this article.
Gotcha.
But let's show
Lighter, the token here is LIT. So, Lighter, man, what a run. So from the beginning of May, the middle of May to, just a couple of days ago, Lighter, the LIT token rallied from 84 cents all the way up to $2.76. That is a return of 230% in 60, 70 days, something like that. Amazing performance. Now, if we throw down a little bit of trend line support here, we'll be able to see, okay, well, if Lighter corrects, where would you expect it to find support? Right here. Let me go ahead and grab an arrow tool. You would expect it to find some support at trend line support. And then what we could do here is throw down a horizontal, and that would be our level of resistance. Done. Boom. Now, let's go ahead and see if we can throw down a moving average. Now, a 200 period, I can't throw down a 200-day or a 200-period moving average here because there's not enough data. Yeah. But what I could do is throw down maybe a 100-day moving average. Now, this is a little bit concerning because the 100-day moving average is well below the current spot mark price for this LIT asset. This is referred to as an extension. So right now, price is extended from the 100-day moving average by nearly 70%. That is a pretty significant extension. That tells me that maybe price has gotten ahead of itself a little bit. Mm-hmm. So a corrective period here, I think, would be healthy, especially if LIT is able to hold support. Now, if it doesn't even get down to support and just continues to rally and breaks out above $2.75, well, then that's referred to as price discovery. So if it re-enters price discovery here and just continues to rip, then what do you do at that point? You got to start pricing it in Bitcoin terms. So if you then price LIT in Bitcoin terms, you can see, okay, is it outperforming Bitcoin or not? The answer is yes, massively outperforming Bitcoin for the last couple of months. This is amazing price performance out of LIT. Here's something else that I would really be interested to do here. I would want to price lighter in hype terms. These two protocols are
See if
competing
it's
with one another.
outperforming.
Let's see if lighter is outperforming hype. My guess is that it is. Let's see. And it has been. Yes, you see that? So since the beginning of June, LIT has been outperforming hype. Now, this is a trend change. You see that level of horizontal resistance that I just threw down there? The fact that LIT was able to break out in hype terms above this level of horizontal resistance, that signals that this could be a bottoming formation. So LIT could have found a bottom and some type of an intermediate term low in hype terms. So if you think that these these perps dex tokens, LIT, HYPE, maybe you could even throw Aster in there. If you want to compare these against one another, price them in each other. And so the idea here is you want to be long the best and short the rest. So if you were going to trade this, you would be long lit, short hype. That would be the trade setup here.
All righty. Let's finish out this one before our deep dives. But it says that the Robinhood chain perps now run on lighter. Vlad Novakovsky maps the revenue split, the USDG collateral risk, and the race for a US perps license. So Robinhood chain went live last week, and the perpetual futures powering it are from Lighter. The on-chain exchange Robinhood backed before Lighter launched its token. Vlad, founder and CEO of Lighter, joins Laura to unpack a partnership he says had been building since he and the Robinhood founder were high school classmates. He details a 50-50 revenue split, why USDG has collateral, creates friction for market makers, and how a pending CFTC license would cover Robinhood's own front end as well. So Novakovsky also addresses the crowded field forming around US perps, from Kalshi and Coinbase to Kraken and DYDX, and makes the case that on-chain volume keeps gaining share even as crypto-native tokens lag real-world asset perps. His new seat on the CFTC Innovation Advisory Committee, again, an advisory committee. I mean, don't read too much into that. Puts him in the room as regulators decide what a DEX has to look like to operate onshore. It is bullish, but don't mistake that. I mean, they are one voice in a room. Don't mistake that as they are the chosen one. Because that's a lot of the posts I see on these advisory committees is, a lot of these communities will try to post it that they're on this advisory board, and that instantly makes them the chosen token and the chosen chain. So be very, very careful with that. So with that, let me kick it over to you, David, for the deep dive.
All righty. So let's hop in here. We're going to take a look at Maple Finance. And before we do, I just want everyone to know the performance of the MPL token real quick. So I'm just going to bring up MPL USD, and then we're going to hop into the deep dive. So here's the Maple token. And, this thing, let's just go ahead and zoom out to a weekly here real quick and see what we see. And then we're going to hop into that piece of deep dive research. I'm going to throw down that 200-day moving average, which you can barely see. There's this is actually a 200-week moving average, excuse me. So this 200-week moving average comes in right now at, let's call it $15. And MPL, the token, is trading below that 200-week moving average. And importantly, it put in these wicks on the upside. So these are referred to as tweezers. So if we zoom in here, there's actually a couple of tweezers. So you got a tweezer here and a tweezer here. So these are topping formations. These are not bullish. So just wanted to point that out. Let's bring it on back into the deep dive. And I'm going to go ahead and play this video content.
In the early digital asset era, decentralized credit relied on unsecured lending pools that often lacked transparent recourse. By 2026, these high-risk models have been largely superseded by institutional credit infrastructures built on secured, over-collateralized positions and professional underwriting. This chart tracks Maple Finance's active metrics through the first half of 2026. The protocol's total assets under management reached approximately $4.6 billion, with outstanding active loans scaling to $1.9 billion. Simultaneously, the platform managed to eliminate its reliance on artificial token emissions. That shift in capitalization did not happen organically. In late 2022, the protocol absorbed a $36 million default tied to orthogonal trading. That specific credit failure exposed the vulnerabilities of standard, unsecured lending pools in crypto markets. In response, Maple's core contributors discarded their existing underwriting framework and executed a complete architectural rebuild of their operational model. Scaling an institutional credit protocol requires resolving an inherent friction in decentralized finance, bridging the strict legal compliance demanded by corporate borrowers with the permissionless on-chain liquidity supplied by global depositors. Institutional allocators, such as proprietary trading firms and liquid funds, operate within tight regulatory boundaries. They require absolute adherence to know your customer and anti-money laundering onboarding, alongside institutional-grade custody solutions, before they can deploy capital. The DeFi native ecosystem demands the exact opposite. Retail users and DAOs prioritize permissionless access without identity checks, automated yield generation, and highly composable receipt tokens that can be utilized elsewhere on-chain. Maple resolved this tension by engineering a bifurcated dual-product architecture. The protocol split its operations into two parallel access gates, deliberately isolating the institutional risk assessment from the retail capital acquisition. To unify this dual structure economically, the community passed a series of governance votes, transitioning away from the highly inflationary legacy MPL token. They consolidated the platform's value capture into a modernized, strictly governed asset denoted as Syrup.
Wow. So, Mike, this is what we're always talking about, value capture.
This architectural pivot aims to replace the reliance on artificial token emissions with a system where token demand is linked directly to the actual revenue generated by the protocol's lending book. This diagram maps the flow of capital through the modernized protocol. On the right is the open access gateway, Syrup.fi. Designed for the retail audience, it requires no KYC and utilizes standard ERC 4626 tokenized vaults.
Okay, so those vaults, that's the architecture that Morpho uses, that Euler uses. So these vaults can be deployed by anyone. If you're a developer, you can deploy vaults like this.
Aggregate stablecoins like USDC and USDT. In exchange for their stablecoin deposits, retail users instantly receive liquid Riber tokens, Syrup USDC or Syrup USDT.
Okay, so those are the liquid wrapper tokens. So Syrup USDC, Syrup USDT, those are the wrappers. Remember we were talking about wrappers earlier?
Yep.
These receipts automatically accrue yield generated from institutional credit spreads. Syrup.fi operates strictly as a downstream funding channel. The aggregated retail liquidity is pushed directly into the central over-collateralized lending pools managed on the main platform.
Okay, so there's a big risk here, and I've got to highlight this risk.
Yeah.
So when you take your USDC or your USDT and you swap it for Syrup USDC or Syrup USDT, you've got to know what is the source of that yield. And so if they're talking about institutional credit spreads, well, okay, what credit products what are they holding? What is Maple Finance holding to generate that yield that they then pass along to you, the token holder? If you don't know the source of the yield, you are the yield. Now, I'm not saying that that's the case here, but you've got to know what's the source of the yield. What exposure does Maple have to, company ABC? You've got to know what credit products are they holding.
On the left is Maple Permissioned. This gateway serves verified corporate lenders and treasuries. Access is blocked by strict regulatory firewalls, enforcing comprehensive identity verification before any entity can interact with the pool. Once verified, borrowers must post heavy over-collateralization, typically between 105% and 130% of the loan value, in major digital assets like...
Okay, so that's a red flag. If it has to be over-collateralized to the tune of 130%, well, what does that tell you about the risk of that product? If you need a 30% over-collateralization, man, that tells me that there's a lot of volatility potentially in that underlying asset, whatever they're holding. If they're going to force you to post 130% over-collateralization, there must be volatility in that thing.
Like Bitcoin, Ethereum, or Solana, to draw funds from the central pool. To meet institutional safety mandates, this collateral is never held in speculative smart contracts. It sits in fully regulated institutional-grade custody solutions managed by Anchorage, BitGo, or Sygnum Bank. This architectural bifurcation isolates legal compliance on the institutional side while maintaining permissionless access for the retail depositors funding the loans. Underwriting these institutional loans requires human oversight. Maple delegates credit evaluation to expert managers, known as pool delegates, who conduct physical due diligence and negotiate specific loan terms off-chain. Customized institutional credit agreements involve legal contracts and highly specific repayment schedules. They cannot be reliably liquidated by automated algorithms, requiring professional credit officers to structure the risk. This chart details how the protocol aligns the delegates' incentives. Before approving loans, delegates are required to post a first loss capital tranche, usually between 1% and 5% of the total pool, using their own stablecoins. If a borrower defaults and fails to repay the principal, the resulting financial impact hits the bottom of the capital stack first. The delegate's personal first loss capital is burned entirely to cover the deficit, before the senior retail or institutional depositors lose a single cent of their principal.
Okay, so this is the type of structure that we see over and over again for these products on chain, where there's a junior tranche that takes losses first, a senior tranche that takes losses last. The problem with this is if there's an issue with the underwriting of those credit products, because if you're a retail investor and you're investing USDC or USDT into that syrup USDC or USDT product, and then what they're doing is they're taking your liquidity and using it to issue loans to God knows who, what business, where, I don't know. What happens if that business fails to repay the loan? Well, you could suffer significant losses if you're holding that syrup USDC or USDT product, it looks like.
By ensuring that the underwriter takes the primary financial hit for a bad loan, the first loss capital mechanism structurally penalizes poor risk assessment and aligns the delegate's financial survival directly with the safety of the protocol's depositors. This diagram outlines how those off-chain loan agreements generate on-chain protocol revenue across three distinct channels. The first channel is the establishment fee, an annualized 1.00% charge levied upon loan origination. The protocol takes 2/3 of this establishment fee directly into the Maple Treasury as revenue.
Okay, so Mike, this is the value accrual model. And what we want to see here is we want to see these fees accruing to that MPL token and or the syrup USDC token or USDT token in some way.
So my understanding is the MPL token is being replaced by the syrup token.
It could be. I don't know.
While the remaining third is routed to the pool delegate as compensation for originating the deal.
The second channel is the platform management fee. This applies a continuous 0.25% to 0.99% annual charge on the total pool assets under management, providing a steady baseline of treasury revenue. The third channel, the performance fee, applies specifically to actively managed books. After the required loss reserves are filled, the protocol captures a percentage of the net interest income generated by the pool. Through these three specific extraction pipelines, off-chain institutional credit demand is transformed into continuous, programmatic cash flow for the decentralized autonomous organization. Relying on real cash flow marks a sharp departure from Maple's past, where the protocol utilized inflationary emissions of the native token to reward active stakers. Active smart contract staking creates severe operational bottlenecks for regulated entities. Asset managers and Phelan offices face structural custody limitations and immense tax reporting complexities when managing small, continuous token distributions. Recognizing that this friction blocked institutional allocators from holding network equity, the community passed Maple Improvement Proposal 019 in October 2025. MIP 019 executed two critical actions. It permanently halted all inflationary staking rewards at the end of the November vesting cycle, and it redirected 25% of all ongoing protocol revenue to a newly established treasury pool, the Syrup Strategic Fund. Ending emissions removed the administrative burden of staking.
The Syrup token transitioned from a speculative tool requiring constant active management into a passive asset designed to sit quietly on institutional balance sheets. This graphic demonstrates MIP-021, activated in July 2026. To formalize token scarcity, the protocol replaced discretionary treasury actions with an automated, rules-based engine that determines open market syrup buybacks based exactly on monthly revenue. In Tier 1, when monthly revenue is below $1.5 million, the token buyback rate drops to 10. When analyzing these on-chain...
So sometimes these pieces of video content can get a little messed up there, but this is super important. Yeah. This is that value accrual model. So yeah, well, we'll come back to this.
$5 million, the token buyback rate drops to 10. When analyzing these on-chain cash flows, quantitative analysts evaluating Maple Finance must account for a persistent structural data anomaly on major automated tracking platforms like Coinbase. Automated dashboards frequently display summaries indicating that Maple Finance acquired the payment networks CoinMe and Sequence for $250 million in January 2026. This data is entirely false. Those strategic acquisitions were actually executed by Polygon Labs to construct a regulated U.S. payments network. The appearance of this claim on Maple's profile is a metadata scraping error caused by natural language processing pipelines misinterpreting multi-protocol research reports. The deterministic on-chain rules of the MIP-021 buyback dashboard provide a verifiable countermeasure, protecting global allocators from both protocol inflation and off-chain data hallucinations. This matrix outlines how Maple positions its architecture against the other leading decentralized credit networks in 2026.
Okay, Maple Finance, Centrifuge, and Goldfinch, not good. Mike, did you see what happened to Goldfinch over the last 6, 8, 12 months?
No.
This one basically blew up. And then I think haven't we run a deep dive research on Centrifuge? I'm pretty sure that we have. Yeah.
Centrifuge and Goldfinch. Centrifuge focuses on securitizing off-chain assets like real estate and structured finance, utilizing a tin lake model with automated senior and junior tranches to manage risk. Goldfinch connects capital with emerging market corporate debt, relying heavily on a network of decentralized auditors and backer pools to...
Okay, so when we were learning about Maple Finance and those underwriters, well, that's what blew up for Goldfinch. I don't know who was underwriting those, those loans that I think they were making loans. It could have been like gold backed or something like that. But whoever was doing that auditing really messed up, man. There were a lot of guys who lost their shirts with that Goldfinch protocol.
Yeah.
Write loans in developing missions. Maple Finance operates uniquely as a hybrid platform, targeting crypto-native institutional debt by relying on human pool delegates and their strict first loss capital mandates. The combination of human expertise and physical due diligence positions Maple as an on-chain...
Wow, look at this guy. He's literally in the desk.
analog to traditional institutional credit funds, offering allocators a familiar risk management framework within a decentralized environment. Despite structural buffers, borrower default remains the primary unmitigated risk for any platform dealing with under-collateralized off-chain entities. The platform also faces ongoing legal friction as it attempts to merge traditional compliance with decentralized finance. In late 2025, the Core Foundation secured an injunction in the Cayman Islands that temporarily blocked Maple's planned Syrup BTC yield product over exclusivity disputes. To maintain trust amid these structural hurdles, Maple partnered with the network firm in May 2026 to execute a rigorous proof of reserves program, providing independent third-party verification of solvency for the Syrup USDC and Syrup USDT vaults. Following the complete tokenomic overhaul, the modern Syrup token operates as a programmatic cash flow capture instrument, mechanically linking the protocol's multi-billion-dollar lending volume to continuous open market scarcity. Maple Finance proves that the future of tokenized private credit lies in transparently distributing real-world yield through public ledgers, completely eliminating the need for artificial liquidity incentives.
Okay, so that's pretty interesting. Now, what is the URL for Maple Finance? I'm going to hop on over here to DeFi Llama real quick and see if I can
I got it
Yeah.
pulled up.
Maple. Here it is. So this is a $2.25 billion TVL protocol, pretty significant in DeFi right now. And the fact that the TVL has increased and not really, gone back down to where it was at the beginning of the last bull, that's a big thumbs up. And this looks almost like a flag. So you can paint flags on any asset chart or any chart period. So, okay, this is a good sign. Let's scroll down here. Let's see if there's an income statement. And scrolling down, there is an income statement for Maple, and it looks like they make money. So this is an important thing that we're always watching, right? So at the bottom of the income statement here, yeah, what I see is earnings, positive earnings, man. This is a good sign.
There's a banner on their website that says Maple brings on-chain credit engine to Robinhood chain with Syrup USDG. Live now on Ethereum and Robinhood chain.
I see that. Yeah, let's take a look at that. So Syrup USDG, man, I'm looking forward to that deep dive research tomorrow on Robinhood chain because I see the volumes over there just exploding on Robinhood chain. So this is super interesting to me. Now, let's say that I wanted to access this product and actually use it. How could I do that? Well, if I click Enter App, okay, so take a look at the yields here. This is a red flag. So now that we know how these yields are generated, okay, so if I'm a holder of USDC, I'm retail.
A lot of risk, not a whole lot of reward.
Exactly. So 4.7%, that's treasury yield. If you're taking significantly more risk than holding treasuries, well, you've got to get compensated for taking that risk.
Or why not just buy treasuries? Right?
Yeah. So, I mean, you got to ask yourself, is 4.7%, is the risk worth it to earn? Is the juice worth the squeeze?
And I mean, unless you want to take, maybe if you levered it, if you can use Syrup USDC in some, DeFi strategy or something like that to lever up in a significant way to make it worthwhile. I don't know.
That's a good point. That's exactly where I was going to go next. So we've got a couple of protocols that we can take a look at to learn about that. The first of which is going to be Pendle. The second of which is going to be over here on Camino. So I know that there's a large, or at least I believe that there was at one point, a lot of liquidity for Syrup USDC here on Solana. So let me see if I can find it. Syrup USDC. Okay, got it. So here's a couple of markets on Solana. This is on Camino. Camino is one of the largest money markets on Solana, if not the largest. I think it's number 1 or number 2. Now, if we just take a look at these Syrup USDC products, okay, great. So we now know that if I am a retail investor and I swap into Syrup USDC, I'm earning 4.7% on my collateral. Now, we were talking about looping a second ago. If I want to run an interest rate arbitrage play where I'm earning 4.7% on my collateral, and then I borrow against it to lever up that yield, well, I've got to be able to borrow for less than what I'm earning natively on my collateral. So if I'm earning 4.7% on Syrup USDC, I've got to be able to borrow for less than that. You see where it says max leverage APY here? So if I just sort by max leverage APY, it looks like I can borrow either USDS or PYUSD. So USDS is the old MakerDAO. They transitioned to become Sky money. So this USDS...
We did a deep dive on Sky.
We did, yep. So that's USDS is the Sky product. PayPal's product is PYUSD. I would never touch PYUSD. I don't like PayPal. But looking at this, the fact that these max leverage APYs are so low, and maybe it's just me, but I think these are relatively low. The fact that these are relatively low tells me that if I click through here, my guess would be, yes, I can borrow USDS for less than 4.7%, but not much less than 4.7%. So if we scroll down here, let's take a look at this. So max leverage APY, 14.59%. We know the native yield on Syrup USDC is 4.71%. So if I scroll down, what I'm looking for is what's my borrow APR? How much am I going to have to pay to borrow USDS to lever up my exposure to Syrup USDC? That's the question here. So as we're scrolling down, that's what I'm looking for. And sometimes these markets, these protocols make it a little bit difficult to find the information that you need. So I need the borrow APR for USDS. That's what I need to see here. I think, there we go, USDS borrow APY. So this is going to be that orange number.
Why in the hell didn't they put that at the first fucking screen?
I know. Yeah. So sometimes you got to dig around. You got to know what you're looking for on these money markets. Whenever you're engaged in interest rate arbitrage, you got to find these data. Super important.
It looks like it's fluctuated between like low 3% to like up into the like a little bit above 5%.
So up that blue line there, that's the syrup USDC APY, and that orange line, that's the USDS borrow APY.
Yeah, and it looks like it's fluctuated over time between like 3 point, something percent up into just above 5% over time.
So this period of time here, back in the middle of June, this would have been a period of time where it would not have been profitable to lever your exposure to syrup USDC because you're paying more to borrow than what you're earning on your collateral.
Mm-hmm.
Can't run that trade.
That's a losing position.
It is a losing position. So the difference between the orange line and the blue line, that's referred to as your variance risk premium. So that's your ARB. That's your interest rate ARB right there. The difference between the blue and the orange lines. When the orange line's above the blue line, you can't run the trade. When the orange line's below the blue line, you can run the trade, but you got to keep in mind, these are variable yields.
Mm-hmm.
So your borrow APR could spike and become greater than your collateral APY.
And start eating up any profits you might have generated. And, you got to keep, as always, keep in mind the fees, and
yes.
any bridging, all that sort of thing. And then, potentially slippage.
Transaction costs.
Yeah.
Yeah. So you've got, if you're holding assets on an EVM chain, you've got to first bridge those assets to Solana.
Mm-hmm.
And then once you bridge to Solana, you got to make sure that you swap into syrup USDC.
Mm-hmm.
And then once you swap into syrup USDC, you got to actually run that levered trade. So you're probably going to be running a batch transaction on Camino,
mm-hmm.
where I would guess that there's some type of flash loan, and you're able to immediately in one transaction, get that max leverage in one transaction. But you got to keep in mind the transaction costs. You got to keep in mind, is there going to be any slippage there? So those transaction costs can quickly exceed your profit for like a long period of time, where you might get stuck after transaction costs sitting in an interest rate arb play for 30 days just to get back to break even. So you got to be careful with this stuff.
And and that's where like position sizing comes in and things like that.
Yep. And so, if I'm looking at this, if I'm earning 4.87% on syrup USDC and borrowing USDS paying 3.83% APR, that spread, what is that spread? That's like 100 basis points, basically. So you're earning a 1 point spread, a 1 percentage point spread, 100 basis point spread. How do you actually make money on that? Well, that's where, if we just scroll back up to the top here, take a look at Loop Info.
Mm-hmm.
You see the LTVs? These LTVs are going to tell you how much leverage you can use. So you can also see, this is nice. Many money markets don't give you these data where it says average leverage taken. That's kind of interesting to see that most levered participants in this market on Camino are using 4.70x leverage. That's kind of interesting. It looks also like, because of these LTVs, the max LTV here of 88%, that tells me how much leverage I can run. But I can also see that here on the slider. So you see the slider, I can slide it on over to 7.9x leverage. That is a function of the max LTV. So if the max LTV is 88%, then that tells me how much leverage I can run. If I've got a 100 basis point spread and I run 7.9x leverage, that's how I get to my max leverage APY of 14.59%. Now, what is the ruin risk here?
Mm-hmm.
Well, if you're running max leverage and your collateral depegs by a couple of percentage points, you've got to multiply that depeg percentage by your leverage ratio to figure out what your losses would be on a levered trade like this. And those losses on a DPEG, even a small DPEG, if you're running 8x leverage and there's a 5% DPEG, you're suffering a 35% drawdown in your principal. Right? That's not good. Yeah. So you gotta just understand that, these interest rate arb plays are super interesting. But what's the comment from Lucas Hawkins that you posted up here on the screen?
Says, have you guys heard of XCN staking percents? In some cases, it's around 20%. Thoughts on staking?
Okay, so isn't XCN
is a token?
Yeah, I think it's man, isn't it one of those doo-doo ISO tokens? I think something like that.
I've never heard of it. Let me take a look real quick.
I think when I've heard of XCN in the past, it's been, one of those mentioned in the same breath as like XRP, XLM.
Onyx. Looks like it's Onyx coin.
Tell me about XCN token. So
what I got on here while you look that up, it says it's an infrastructure for a multi-asset, scalable, and cryptographically secure ledger. Onyx functions as a blockchain-based technology that enhances financial ecosystems by enabling a more efficient and interconnected economy with a mission to develop cryptographic ledgers that optimize security, scalability, and usability. That's all blockchain.
Oh, man. All I heard there was buzzword, buzz. Yeah, I didn't hear anything actually valuable there, though. That's a problem. So, and then, Mike, when we take a look at the price performance of this XCN token, man, like this is not what you want to see. This is horrible. So here's the thing, for the comment from Lucas Hawkins. So if you're earning 20% to stake a token that does nothing but go down, okay, that's not what you want. So that 20% APY, that can be extremely misleading. You've got to understand the tokenomics for this XCN thing. And No Hype is saying a nothing burger. Yep.
It looks like the other website says staking APR is 25%, circulating supply of 37 billion, a max supply of almost 70 billion. And the average gas fee is like 0.0002268.
You see what Tinkle Bell said in the chat? Didn't understand a word of what you said. So tell us, what was it? What was it there, so that I can go back through it, and I'll keep it simple. But
basically everything that I'm seeing on their website right now it's basically the same narrative that a lot of different crypto projects are trying to address. They want to be the high performance layer one blockchain designed for payments, financial institutions, and real world applications. That market, that use case is so saturated, and there's so many people that have a head start and that are actually actively have people onboarded for that use case. So I would be very careful. I'll leave it at that.
And I just hopped on over here to the Onyx website, and what I see is this UI UX reminds me of a couple of protocols that blew up last bull cycle. But that's the first thing. It's just the UI of it. The second thing is the staking APR for XCN is not 20%. It's 11.90%. The staking APR, it looks like, for the Onyx coin is 30%. So this Onyx coin must therefore be like a governance coin, I would assume, something like that. Whereas XCN looks like it might be the native coin for that chain, which looks like it's a layer 3 chain.
Yeah, but it's the gas token.
Yeah, yuck. And then if we take it on over here to DeFi Llama, this is obviously not what you want to see either. This is not good.
No.
So I would stay far away from this. And one thing that
to be fair, there might be there might be some tokenized RWAs on this chain. I doubt it, but if there is, it's not reflected in that 25,351. Just to be fair.
Sure. Yeah, good point. But here's a logical fallacy that I see a lot of investors in digital assets, fall for
It's cheap.
over and over. Right.
It's yeah.
Exactly.
It,
That's the fallacy. So, if we take a look at this and just zoom in, this is a weekly chart. Yeah. So let me just zoom in from a weekly to a daily,
well,
and
you
let's
know what?
just
Let me give a quick example. A project I was really bullish on, and not to say that it can't, that the project itself can't be successful. I just didn't like the tokenomics. We were very bullish on Plume for a long time. I was making like 3,000, plus percent APY for a couple of months off of it. Made a bunch of money off of it, reinvested in other projects, and a big part of why I'm not as down as most people are right now in these markets. However, luckily I sold, a bunch of it and, moved it in other projects that have done really well, but I had a decent sized bag of Plume that I rode down. And, even though it has a very bullish narrative, it's an RWA chain, they have Nest credit. There's a lot of good stuff going on. The tokenomics were such that it doesn't benefit you to hold the token. So, if you're earning, like David's talking about, if you're earning 20 or 30% on it, but, it continues to go down, are you losing any profits because the price of the token is, going down faster than the earning that you're making?
So if you're earning 20% APY on a coin that's going down by 20% every session, yeah, no, not exactly a good thing
Well,
there.
over the past year, like I don't know when they bought, but over the past year, how much has the price gone down?
For this XCN token, well,
Yeah.
I mean, if we measure from the highs in January 2025 to the current mark price, it's down 95.5%.
So
So
if you would have held it, over that time frame, you might have earned 20 or 30%, but you've lost 90%.
yeah, 95.5%. And just to get back to break even,
Yeah.
you need, like, what is that, a 3,000% return just to get back to break even? If you bought it at these all-time highs, you need a 30 bagger to get back to break even. That makes that 11.90% staking APY completely meaningless.
Yeah.
So yeah, that fallacy though of thinking, oh well, it's cheap. It's only, what is it, 0.00083 cents per coin. Oh, it's so cheap. If I just, buy a bazillion coins and then it goes to $1, I'm a bazillionaire. Well, that's a fallacy though. The market is telling you it's cheap for a reason. Okay. So this thing here, I would run in the opposite direction. Just taking a look at it, a cursory look at it. Let's bring it back to the Intel library and
Yeah.
let's take a look over here at the next project. Alpend.
So Alpend is a Canton network application that they are about to launch, and so basically like a protocol or a DEX.
Okay, so
And Scott, I think that I forget if that was his name, but when he was on Friday, he was the one that he got early access to it. Remember, he said he was making a bunch of free Canton, doing some different DeFi plays on it.
I vaguely recall that.
It wasn't much. It was like 10 or 15% or something like that. But still, I mean, that's the most I've been able to heard anybody make off of using their Canton so far.
So one thing, Mike, that I want to just let everyone know is that, excuse me, is that when you're in the Intel library, you can click Share to X, and when you click Share to X, it's going to open up your X account. You'll be able to post any of this deep dive research to your X feed, just like I did just now. So on the DeFi University X feed, I just posted that we're running through the deep dive research on Alpend right now at the node.pro. So anyone can do that. A cool little feature that I built in. Let's play the video content. This will be interesting.
Public blockchain environments operate like glass labyrinths. Every move is visible. For high-volume institutional borrowers, this transparency creates a predatory environment where liquidation hunters and MEV extractors actively analyze mempools to front-run large positions. By 2026, corporate treasuries and asset managers require transactional privacy. To safely deploy nine-figure credit lines, they need the ability to mask their collateral ratios and market positioning from the public ledger entirely.
Yeah, they do.
Enter Alpend. Built natively on the Canton network by Palladium Labs, Alpend is deployed specifically to provide these compliant, institution-ready credit rails. This diagram illustrates the architectural difference. On the left, traditional public pools leave data exposed. On the right, Alpend utilizes Canton's selective disclosure capabilities. All deposits and lending strategies are isolated within encrypted, private synchronization domains, operating behind an opaque boundary. This privacy-preserving model has already secured massive institutional traction. Major financial entities like DTCC, Goldman Sachs, and HSBC are actively executing workflows across these isolated domains. But isolating data creates a structural conflict. The Canton network distributes its block rewards based on mathematical proof of a protocol's transaction volume. That volume must be verified by a central public ledger. To earn those network rewards, an application must continually prove the scale of its activity to a public synchronizer. If Alpend transmits that raw data, it compromises the exact cryptographic shield its institutional clients require. How does a protocol claim public yield based on transactions that are actively hidden from the network sequencer? To function as a viable institutional primitive, Alpend must execute a perfect cryptographic bridge. It has to translate private economic activity into public validation without leaking a single detail about its users. Looking at this contract dashboard on Base, you will see an EVM-compatible Alpend token, but the circulating supply and market capitalization sit exactly at zero. There is no active trading history. Alpend entirely bypassed the standard retail liquidity model. There is no dilutive, highly speculative governance token used to attract early capital. Instead, the system relies on Canton Coin, or CC, the native utility token of the synchronizer. Canton Coin launched with zero venture capital allocations, no pre-mines, and no ICOs. This flow diagram maps out Canton's burn-mint equilibrium. The economics are straightforward. Transaction fees paid by users are permanently destroyed in a furnace mechanism. In response, new Canton coins are programmatically minted to active network contributors along a predictable supply curve. Those newly minted tokens are distributed on a strict schedule. Standard and super validators receive a combined minority share, while the dominant stream, 50.87% of all newly generated tokens, is routed directly to what the network calls featured apps. To offer highly competitive lending rates, Alpend must capture its portion of that dominant 50.87% reward share. By aggressively capturing the network's foundational monetary policy and routing those newly minted tokens directly to capital providers, Alpend engineers its yield without inflating a speculative asset. The mechanism Alpend uses to bridge its private state with that public reward stream is the activity marker. This animation represents a private DAML smart contract. Every time a deposit, borrow, or liquidation executes in secret, the contract consumes a small Canton coin fee and ejects a cryptographic activity marker. These markers represent pure, abstract economic weight. They carry no sensitive user data. At the end of each epoch, they are batched and validated by the Layer 1 ledger, which triggers the release of the newly minted Canton coin rewards back to Alpend. This system immediately invites a clear exploit vector, automated wash trading. A user could write a script to rapidly deposit and borrow the same asset in a loop, generating massive amounts of artificial markers to farm rewards. To prevent this, Alpend enforces strict protocol-level firewalls. The first is Atom blocks the marker generation entirely. The second firewall relies on mandatory cooldowns, enforcing wait times between consecutive state modifications, so rapid-fire actions fail to trigger validation. Third, minimum value constraints dictate that only high-value, institutional-scale volume qualifies for marker generation in the first place. Finally, network access requires verified Canton IDs linked directly to institutional KYC and AML records, neutralizing anonymous Sybil attacks. By stripping complex financial data down to strictly filtered, zero-knowledge weights, Alpend proves the legitimacy of its volume to the sequencer, while keeping its clients' corporate strategies entirely hidden.
Alpen's structural design forces all fee-generating events, its interest rate spreads, origination fees, and liquidation penalties, directly into the protocol's reserves, bypassing any central treasury. Depositors on Alpend receive an amplified APY. They earn the pool's organic borrowing interest, stacked on top of the programmatically minted Canton Coin distributions.
And
Structured finance protocols
and
build.
I keep calling him Scott, and so I apologize if you see this and your name's not Scott. I could have sworn
I'm almost positive his name's Scott. Yeah.
Yeah. But that's what he was talking about. Is he got the early access, so he was earning the yield off of the position, and the kind of like I was earning on Braun, the Braun wallet for a while. I was earning like 50 free Canton, each day, and like now it's down to like 2 or 3 because they cut off, because of the halvings. They've been scaling down the amount of newly minted tokens of Canton. And as these different projects are coming online and actually actively processing transactions and data, then the burn is going up. So it looks like Alpend is still earning those I don't want to call them fees. They're earning those newly minted tokens.
Emissions. Yeah.
Thank you. Emissions.
So one thing that comes to mind here as we're watching through this piece of video content, Mike, is there an Alpend token? Because, we're talking about Canton a lot. I know that there are all these protocols that are launching like now on Canton. And I'm interested not just to gain some exposure to CC, but also potentially to gain some exposure to these higher beta Canton ecosystem coins.
Well, like Zenith. They're going to be launching that Zen token, and we interviewed again Gustav from head of research, and we're actually talking with Scott about potentially having Mr. Kim on, the CEO of Zenith, and trying to get Shaw back on from Digital Asset, the creator of Canton Network, on at the same time, and have all of us on and really discuss this because there's something to be said for some of these projects that are launching, and depending on the tokenomics, very bullish on what Zen is doing, bringing those EVM compatible dApps to Canton Network. But you can be bullish on a project and the tokenomics could end up being crap. So, and I even told him, when we were talking about it, when we were interviewing him, that I'll be very interested to see, what you guys do with the tokenomics. Is there value capture? Because
you see what no hype said in the chat.
Yeah.
Need a hoodie that says all facts, no fun. 100%, man, because there's a big difference between tech and tokenomics.
Yes.
That's why we talk about the trifecta.
Yep.
User adoption, user growth. Got to drive revenues. Those revenues need to return to token holders. That value accrual.
In some way. Because if they don't, long term, again, you can trade hype. You can trade volatility. There's a lot of things you can do. I mean, with volatility, you can provide liquidity for shit tokens, and make huge amounts. As long as you understand the risk, you can make huge amounts of money if you get in and get out, quick enough. Then there's plenty of ways to make money off speculation. But if you have a long-term mindset and you're looking for the Googles, you're looking for the Microsofts, you're looking for the not Yahoo. You're looking for the Amazon. Not Yahoo. Forget that. But if you're looking, to try to potentially, get in early on, which of these projects in crypto that are going to be, kind of, again, the Googles or the Microsofts or the Amazon of crypto, you need to look at the ones that have solid token, because we keep pointing it out. The ones that we're doing deep dives on that we're identifying as having good solid tokenomics and value capture are the ones that are outperforming the overall market. They're the ones that are outperforming Bitcoin in a bear market. And not to say that when a bear market or a bull market rolls around and everything starts pumping, not to say that other projects aren't going to outperform, those. But again, a lot of that could be hype. It's just mind share. Whatever is talked about on social media, what if a project happens to, pay a bunch of influencers or, pay for a bunch of digital marketing to, really hype it up to get people to buy the token so that they can sell, and make a bunch of money to fund, bootstrap, whatever, company they're trying to build. That's been crypto historically. That's really, what happens, as far as crypto goes. And more often than not, a lot of these projects fold up shop, and and the people that the founders and the VCs and all that, they, when the token launches, the token generation event, that's why you see that parabolic pump at first of everybody buying into it, and you see that big drop off. Is that's because into that pump, VCs and all the people that got the token early at a super cheap price, they're selling, they're taking profits, and then it corrects. You almost always see that parabolic pump and dump. Almost every project does
it. They call that a liquidity event. So these VCs, the early investors, they look for that liquidity event so they can exit. And we see that over and over and over again. So let's see here, Alpend protocol. We've got a couple of minutes left in the deep dive.
Got us on a rabbit trail.
All good.
Directly on top of this, Ditto Network developed a suite of tokenized yield vaults designed specifically to
So Ditto, I've heard quite a bit about Ditto Network on Canton recently, Mike. That might be a good idea for some deep dive research later on this week.
harvest this dual yield structure. This flowchart tracks Ditto's primary asset, DVUSDCX Core. It acts as an inbound software network, aggregating stablecoin capital from Ethereum and routing it across the bridge into Canton's ecosystem, depositing straight into Alpend. Once inside, Ditto executes a recursive strategy. It supplies the stablecoin to Alpend, borrows against that collateral, swaps the borrowed funds for yield-bearing assets on Cantex, and loops it back into Alpend as a new supply.
Okay, what is Cantex? Yeah, so this is an interest rate ARB.
Yeah.
I wonder, what is Cantex? I'm assuming that this is one of these new Canton dexes. I would assume, just from the name of it, Cantex. That would make sense, right?
I'll look it up while you keep going.
This loop maximizes capital efficiency. It aggressively stacks the organic interest rates alongside maximum Canton coin reward extraction, pushing the aggregate stablecoin yield toward a target of 8. This action instantly
8%.
severed.
Oh man, so it kind of jumped ahead there a second, but if it's looping up that yield to 8% on Canton, well, you got to understand, what is the collateral asset? What is it? What are they borrowing?
So it's Camtex with a C. It's so basically it's a precision trading on Canton, Canton native AMM trading. So privacy, high speed, self custody.
Okay, so AMM is automated market maker.
Mm-hmm.
That means liquidity provision DEX. Perfect, makes sense.
So high speed. It says a high speed Canton native AMM, private, non-custodial, atomic settlement, and programmatic access, public SDK and production for automated and agentic trading, no desks, and integrations can be built directly on Cantex.
Amazing. So if there's an SDK, you can build algorithmic trading agents to work for you on Cantex. Mm-hmm. Really, really cool.
Direct pipeline to the Layer 1 reward mint. Looking closely at this CC View terminal interface, we can see what triggered the suspension. An investigation by Palladium Labs CEO Akash Gaurav revealed it was a clerical data entry error, creating a massive visualization mismatch. A simple mix-up between Alpend's issuer and non-issuer party IDs caused the public UI to display a highly inflated artificial number of activity markers that the protocol had never actually submitted. This was an administrative glitch regarding display data. It contrasts sharply with the technical failure of RapidChain, an independent execution layer on the network. RapidChain experienced a genuine execution bug during a stress test. A debug parameter was left active in production, causing their marker ratio to spike by 885%. Alpend's error was purely visual, yet the network response was identical.
Really
As we see, Canton...
I'm noticing a trend here that we haven't mentioned before, and I haven't heard anybody else talk about. A lot of these different things that are being built on the Canton network, like Cantex, like this, they don't have their own native token. They all use Canton.
Good.
Yeah, that's huge for Canton network.
That's great. The era of governance and protocol coins, it seems as though that's going by the wayside because I mean, what's the value accrual model? You know, so really, really good to see that these protocols on Canton seem to be making use of the CC coin.
Intervenes aggressively to protect its monetary policy. The CIP 116 standard requires featured apps to lock up 5 million Canton coins up front. Furthermore, under CIP TBD, newly minted rewards are held in an observation window for roughly 7 days. Those rewards are only released from escrow if the protocol's mathematical coverage ratio, the exact ratio of fees burned to marker submitted, remains healthy without raising any manual review flags. Institutional networks treat any compliance anomaly as a systemic threat to their monetary policy. Even a superficial reporting error will trigger an immediate L1 quarantine. Public, permissionless blockchains like Ethereum and Solana operate on a single core philosophy. Liveness is the ultimate priority. The chain must keep producing blocks, and applications must remain interactive. On public EVMs, a front-end visualization error or a UI glitch never results in a top-down programmatic suspension of a smart contract's economic connectivity. The Canton network functions differently. Here, strict system-wide economic discipline and state synchronization supersede uninterrupted liveness. Because featured apps dictate the minting curve of the native coin, L1 governance acts as a definitive kill switch against any perceived misconduct or data mismatch. This diagram shows how Alpend navigated the suspension. They bypassed the L1 administrative bottleneck by routing capital through alternative, compliance-aware execution layers, maintaining active yields even with their primary status paused. This pivot to an unfeatured app hybrid architecture successfully uncoupled their high-frequency execution matching from the underlying L1 reward sequencer. Alpend proves that deep, subsidized institutional yield is possible without relying on volatile native tokens. It can be constructed entirely on the back of programmatic burn-ment equilibrium frameworks. For developers targeting corporate treasuries in 2026, building enterprise infrastructure requires decoupling execution from L1 anchoring to survive the uncompromising regulatory tolerances of institutional blockchains.
Seems to me, Mike, like many of these Canton native protocols are building on top of that virtuous flywheel that Canton is working to make a reality. Once that BME gets to 1.0, then any protocol that builds on top of Canton will be, it looks like, rewarded because of that virtuous flywheel effect. Yeah. So yeah, man, this is looking pretty darn interesting to me. Now, what is the URL for Alpend? I want to take a look at that before we end today.
Alpend.com.
Alpend.com. Awesome.
Yeah. Programmable credit infrastructure.
Here it is. Alpend.com. Powered by Canton. Love it. All right, let's see here. Lend, borrow, deploy assets on-chain with privacy provision and settlement certainty. Great. You got some money markets, collateralized debt positions coming soon, it says. Let's take a look at the money markets. Private positions, open markets. Okay, log in via Loop to continue. Get early access. It's asking me to log in. I'm not going to go ahead and log in here. I just wanted to take a look and see, is there anything interesting going on Alpend that we could use now? And it looks like maybe you need to apply for access because Canton is permission.
It's at the very beginning. I believe it had where you can apply for early access. Yeah, get early access at the very beginning. It's not fully launched yet. If you scroll all the way to the top, it has right out under where it says programmable credit infrastructure powered by Canton. It has that early access button.
Got it. Yeah. It wanted me to log in. So if it's asking me to log in with Loop, I probably got a KYC. And I see Scotty D saying in the chat that I'm changing and I'm interacting with flywheels now. Yeah, man, that's funny. But we look for that trifecta, right? So it's the virtuous flywheel. That's what we look for. So yeah, man, Alpend looks pretty interesting to me. I would like to maybe use this at some point. I'm really interested to take a look at Cantex too, that programmatic DEX. That'll be interesting.
I'll write that down. So basically what I got right now is Robinhood and Lighter for tomorrow, and then we're going to do Ditto and Cantex on Wednesday.
Awesome. Sweet. So with
So,
the remaining 5 minutes that we got, what do you want to do?
well, what I'm doing is I'm actually buying a couple of $100 more at Canton.
CC. Si, senor.
Yep,
Okay,
yep.
so here's CC. Now, the CC token, if we just zoom in, this is the daily. This is the daily chart. So CC over the last month or so has corrected from a high within this channel that I've drawn. That high came in at 17.1 cents or so. It's corrected by 27.5% and bounced after putting in that trough, which came in at 12.45 cents. But notice where it's found resistance. So you see this level of trend line resistance on the upside here for CC? There's the old high at 17 cents, and then lower high, lower high, lower high. And you got this low, lower low, lower low. And you got support down here at 10.7 cents or so. So this downtrend within this larger channel, this is just something to be aware of, that you've got support down here for CC at 10.7 cents. I would be interested to see Canton break out above this level of trendline resistance. We get a breakout above that level of trendline resistance, and then you could start to think about the 200-day moving average up here at 15 cents or so. So that's what I would be thinking about for CC. But with all of the activity, the developer activity that we're seeing, everything being built on CC, looks like this could be a really interesting play for the next several years. And we do these pieces of deep dive research to identify the protocols, projects, coins, tokens, etc., that meet our trifecta and where we can invest for the long term. I'm not trying to trade using 100x leverage, some meme coin to try to hit a 100 bagger.
No.
I'm trying to invest so that over the period, measured in years, I'm able to perform really, really well. And that's why we run the deep dive research.
Exactly. And and I've always said that. I mean, I'm looking to get like a 10x, an average of 10x on my portfolio over the next couple of years, so that basically I can use DeFi. I'll have enough money that I can use DeFi. I can make 10, 20, 30%. Doing different strategies and different portions of my portfolio, and basically just augment my current income. But looks like Scotty D is, how do you even buy Canton? The way that I do it, I've been doing it on Kraken because it's not on a lot of, surprisingly, it's not on a lot of major dexes. You can swap for it inside wallets, like some wallets like Braun and things like that. But this is somewhat still as much as it has going on, it's still flying under a lot of people's radars. I don't know
Not
how.
ours.
Yeah,
Not ours.
no. We've been talking again. Like we were one of the first channels that started talking about Canton. Because it popped up on everybody's radar, and it was like the day that it popped up on RWA.xyz. I messaged Drew over at Blockchain Basement and Discover Crypto, and I was like, dude, have you ever heard of a project called Canton Network? And he was like, no. He's like, what is it? And I'm like, dude, I don't know. It just popped up on RWA.xyz with like $400 billion of TVL. And so, yeah, I mean, it's there's, again, Scott, over on, I want to give him a shout out, Longview Compute. He is the person I've found so far that is the only person that is more knowledgeable about Canton Network than we are. And he is very, very knowledgeable about it. We had him on Friday, and we're talking to him about, coming on the show, somewhat regularly, and getting some other people on to, talk about some of these, projects, and to, kind of debate, the value of some of these, because there were some projects that, he was kind of bullish on for different reasons that I didn't necessarily agree, but that's okay. I could be wrong, so that's why we're here. Like you guys were talking about, facts, not FUD. We're here to tell you the bullish and the bearish on every project. And again, as much as we talk about Canton, we are always pointing out it's still early and it's still inflationary. So, those tokenomics that we talk about, that value capture we talk about, it's that flywheel. It's working against us right now because there's more new tokens, coming onto the market into circulation than are being burned. So we need to understand that, and that's why we're seeing some downward price action right now on Canton. Is I forget who it was, but one of the super validators or validators sold a bunch of their tokens, and
Yeah, that
they
was last
basically
week.
they basically took some profits. So we got to understand the tokenomics. As bullish as I am about Canton, I just bought more. As bullish as I am on the project, you have to be able to acknowledge the bearish and the bullish, the good and the bad. You have to. So
Yeah, it's about not having an emotional attachment to an investment. It's about finding objective truth. We seek truth. So you get as many pieces of data as possible. You get all the facts you possibly can get your hands on, and you make a decision from there. You don't say, hey, I feel a certain type of way around some coin or token. Feelings are going to get you wrecked. Instead, what we do is we run the deep dive research. We gather as many pieces of data as possible. We make a decision from there.
Well, and emotions are going to suck you into confirmation bias and echo chambers as well. Because if you're ruled by your emotions, and this is what we teach, in our free online, DeFi University. So we, unlike most channels, we give away most of our stuff. So we want you all to be successful. So at the node.pro, this is our official website. We have a full education program that we give away. We do not charge for this at all. There's no catches, there's no gimmicks. And that's one of the things that we teach is we teach about, being unemotional in investing. And the reason is because emotions can be taken advantage of. If a bunch of hype is put out about a project, we see it all the time in projects, and they'll hype the shit out of it. A bunch of people FOMO in because they want to get rich, and the price pumps, and you see, and a bunch of people are like, it's going to the moon, we're going to 100x, and people stay in. The emotional people stay in, while the smart people, the unemotional people, are taking profits. That's why they talk about take profits, not screenshots. Is you have people taking screenshots showing how rich they're getting, and they're not peeling off any profits, while the smart people are just laughing while they're just slowly taking profits while that
exiting. Yeah, they're exiting. And so I see what Crispy said in the chat. How much is the monthly? So Mike, today I'm going to be building out a $29 offer for the Node.pro. And what that's going to be is a live call every Friday. So in the community there where it says source room, I'm going to rename that to community. So the products that we offer here are the $29 a month live call. That's one call every Friday for an hour. And also the 3 times weekly calls. Those are the premium calls, Mondays, Wednesdays, and Fridays. And that's $97 a month. So those are the 2 products that we offer at the Node.pro. All of the DeFi
coaching.
And coaching, of course, yeah. But all of the the educational content. Like, look, you should be able to build a skill set for free. It should just cost you your time. And so all of these courses that I wrote for the Node.pro, the DeFi University here, this is all free.
Yeah.
And this is the best crypto and DeFi education in the English language. I wrote the books on this stuff. You can buy the books on Amazon, 5 of them.
Well, and here it is. Introduction to DeFi, start course. So you can listen to it while you drive or work. You can watch the videos. It's kind of the same format as our deep dives. What is DeFi? You got the kind of the one the infographic, but you can just go through and you take this course, and at the end of it, then you end up taking a quiz. So there's quiz and tests to make sure, and you can go through it. Listen to the podcast, video overview, and go through the different modules. And here's all the different modules. I mean, this is the most professional, well put together course out there, and we give it away. Don't go and pay for a crypto course or for an education course. We offer it for free here. And then the community. David's building this out. This is basically our Discord. We got pissed at Discord because we got banned for a day for using spicy language. So we said, screw it, we're out, and we're moving over to this. And then our Intel.
So Mike, the source room,
yeah.
I'm going to be making some really cool updates to the source room today. What I'm going to do, the first update is the live streams that we do. We're going to be able to feed those live streams directly from StreamYard into the source room, into the community there. So they're going to show up at the very top of the page. Anyone will be able to watch our live stream content directly from the source room at the node.pro.
I would love to see this like zoomed like out a little bit.
Yes.
You can see more of the conversation. All right,
yep, I'm going to do that too. Yep.
Love it. All right. And then the Intel library. This is, again, we give this away for free. So all of these deep dives that we go through, 13 of them every week. We're going through and we do all these different deep dives, all your different projects, Avalanche, Algorand, Plume. Some of these are very early projects that Jeff does on the blockchain report. That's usually 3 times a week is immediately after this show. He's really good at finding early projects that some of them don't even have had their token generation event yet. And so you can kind of find those early projects. But all of these are free. We don't charge. Again, I mean, we could package all this and charge for it, but we genuinely just want to educate you here. We are not influencers. We don't care if we think something is dog shit. If you want to invest in it, it's your money. Do what you want. None of my freaking business. If you want to invest in XRP, after listening to the deep dive, none of my business. It's honestly, it's not, and I do not care. I could be wrong. We don't have a crystal ball here. We are just here to educate, and we're here to learn.
One thing about the Intel library too is, I just built out last week emails. So every time we post a piece of new Intel, there's a new Intel dossier posted in the Intel library. If you are signed up at the node.pro, it's free. You can create a free account. If you create a free account, you're going to get these Intel dossiers sent to you via email every day after they're posted. So that's pretty cool. You get free alpha in your inbox.
Again, we give it away here. It's like we have a terrible business model.
It's cash flow negative right now.
Yeah, that's right. Cash flow negative. But that shows you though. I mean, the stuff that we give away for free is this valuable. Potentially, the stuff that, and even the stuff that we charge for, the coaching and the live calls, those you have basically a free discovery call for the coaching and a free trial of the live calls. So if you want to try out the live calls, we offer a week of that. So 3 live calls for free. You can sit in on those. They're live video calls with David and the community. Listen, see if there's value there for you. If it's too advanced or you just think that there's no value, then don't buy it. There's no obligation. But if you find value, then we appreciate the support. But yeah, I mean, everything here, we either give away or we pull back the curtain and let you give it a free test drive. And if you find value, again, purchase it. If you don't. It's that simple. We're all about integrity. We're all about integrity here.
Value for value.
Absolutely. Well, David, that's all I got. You got any closing thoughts?
No, sir. I think, ready to rock and roll, man. That was a great call.
Absolutely. Well, we appreciate all of you for showing up, for contributing in the chat. We love the questions. Always love to see the new names. And if you could, on the way out, if you could give us a like, that is the most powerful way that you can help us get the message out to people, help get people access to this free educational material that we offer, to try to mitigate the amount of people that get taken advantage of in the crypto ecosystem. That is why me, Jeff, and David are here. We genuinely just want you to be educated. What you do with that education's up to you, but please help us get the word out. Like, subscribe, and if you could share, on social media, our channel, and help us grow. And with that, thank you. Until next time, Veteran Crypto out.
Peace.